Okay, I want to continue discussing some core rules of thumb. If you're going to go ahead and experiment with this later in life, or you're thinking about it now, or whatnot, I think that you can't go wrong following these rules, and that you definitely need to at least consider them critically um, before you decide to maybe not embrace them. So, here's another idea. Be really very willing to consistently take losses. Okay, small ones, because as soon as you see the stock beginning to go down, why don't you sell right then and there to minimize your loss? Now this has a lot of troubles if you're doing the scalping idea, where you're trying to buy low at the early part of the day and sell high at the end part of the day, because the day graph is just too variable. But if you're leaving it in for a week or so, and you begin to realize, hey, it never went anywhere, or it's actually starting to go down, sell, take a small loss, come back to play another day, or to fight another day, or to work at it another day, whatever way. But the problem is when you just are always hoping that it's going to bounce back up, and it keeps on falling lower, and then you bounce back up, and then you start thinking, well, I can't sell now because the loss I'll take is just too great. I've got to hang on until it comes back up, and then it keeps on going farther down, and then you realize, wow, how did that happen? How did I manage to lose $1,000 right then and there? I don't know, but that where you realize, man, an hour ago I would have lost only $10. So be willing to take a lot of small losses. I think that's a notion. Here's and related to that. Here's a notion: can a stock go up forever? So when's it coming down, right? How about this? Can an index, now remember, an index is a graph of the market as a whole, or representative stocks of a market, and so they use it to determine how the market is doing. Can the index go up forever? So when you got to be careful with that. Be willing to sell, or to to take the losses, but also be willing to just have that sort of bearish outlook, the carefulness there that says, theoretically, the stocks can't go up forever. So where is it going to plateau? Where is it going to start coming down? That's certainly something to keep in mind. Now, the notion that people have when they have this is, okay, look, obviously it can't go up forever, right? So when is it going to crash? And the anticipation of that often brings the downward trend to be. And there's a name for this principle. Unfortunately, I can't remember the name. But people have studied this and actually have put a name to the notion that because people expect bad things to happen in a market that has had a good run, the bad things actually start happening, not because, the people have some mental powers to influence nature, but simply, hey, it's people's tendency to buy and sell that determine what happens in the market. That's one aspect of it. Okay, yeah, nature has something, to do with it too, as the government and all that sort of thing, but people's own perceptions also can influence the market. And when they start expecting the crash, they start pulling back the money, they start selling, and the stuff goes down, and then people get a little more panicked, and it goes down a little faster, and you can actually start the downward trend very you can start it very effectively, just because 2 months ago everyone was expecting the market to go down. So the notion is it can't go up forever. That's a good rule of thumb to remember. It can't go up forever. Now what about getting that tip, right? And or getting that hot stock or the media flash or whatever. And I would just say this: I think this is a good rule of thumb. If you're not getting it through insider trading, if you are, don't do anything with it. You'll be in trouble with the information. And if you're not working like crazy to get the information and doing tons of research, if you're just kind of getting it through the newspaper, you're probably too late. You're probably too late to really take advantage of that tip. So for me personally, I think that I'm very careful about that. I'm just assuming I'm too late. If I'm just getting it via the public way, the media way, the common shareholder way, and I checked it at 10 in the morning, I guarantee you there are people that are checking it at 7 in the morning, and I'm probably too late to make it work for me in a safe way. The tip. Now, that's not at all to mention that there are some winners out there that actually, the merger is happening, or they're getting rid of that old scamp of a CEO, or they finally, had a breakthrough product, and you can actually see the thing climb for weeks on end. Okay, sure, maybe that's, but it can't go up forever, and you got to be willing to sell, and all these other things come into play too. So there are always going to be exceptions, but it just seems to me that unless you're going to scalp, which means that you're trying to take advantage of that one day, you're going to get in early in the day, get out late at the day because you don't want to leave the money in the market. Then by definition, you have to start leaving your money in the market. And strange things happen over time as you leave money in the market. And what might have been a great gain in 1 week, if you leave it in for a couple more days, might even out, and actually nothing in the end really benefits you. It all balances out at the end because it went up for 2 weeks and then it went down quickly for 3 days, and you didn't sell at the right time. So I know you left it in for 3 weeks, but you're back with just a very minimal profit, and you risked a lot of your money. And okay, so that's the idea. Now here's another core idea, I think. OPM versus MOM, or MOM. All right, MOM. OPM is other people's money, and MOM is my own money. And if you're going to have someone else invest for you, I would suggest that you make sure that they have a little bit of MOM involved, because it's just, the pain doesn't hurt that much when you're losing other people's money and you can get away with it because of the contracts or the high risk idea or whatnot. The agreement signed at the beginning of the whole adventure, the whole investment process, and you sign with an aggressive firm and they tell you up front it's aggressive and they're not going to be responsible for any losses that you can't prove happens by fraud or whatnot. And if it's OPM, just think about it. It just doesn't seem to make sense that they're going to be all that careful with it. You got to make sure that if they're going to lose money, it's got to hurt them too. All right, they can't. So when they're so big that if they lose a little bit of money down there, which is a lot to you because you're not as big as they are, and they just write it off, they're not too concerned about those losses. Why are you getting involved with that? They're not going to be too worried about losing that, as opposed to a very small group of maybe local investors that have their own money invested and they are very concerned about not losing it. I would rather put my money there, right? So watch out between OPM and MOM. The idea here being, if someone has an actual flesh to lose, a hide to lose, they're going to be very careful about it, about their assets. So now here's another rule I think that you should remember, and it goes along with what OPM and that sort of thing, is that nobody is altruistic on Wall Street. In Wall Street, the bottom line is money, and they want to make money, and that's just it. Competition is eventually determined in terms of dollars. The pecking order in a firm in terms of who's really in charge is gauged in terms of which person has the power to regulate compensation for the executive board. In other words, who can actually determine how big the bonuses are going to be. That's where the power is. It's about money. It's about how much someone can make. It's not really about how much someone can make for someone else. Now, they might be willing to have that be the language in which they engage you with to get you to invest their money, and they might actually have to, produce in order to keep investing with leverage, this huge fund. They have to get the people that are investing to keep the money in, so they have to satisfy that. But it really is, how much can they make for themselves? I mean, that's the bottom line. So just remember, Wall Street is not altruistic. So when someone is offering you a deal that sounds too great, you just got to ask yourself, how is this person benefiting from my actually being involved here? Because Wall Street is not altruistic. All right. So of course you realize I'm taking a completely secular view of all of this. And I think initially when we just look at it, because this is a secular activity in its full manifestation. Now it can have, I'm not saying that by definition, it cannot have people that maybe are doing this, that are born again, or that have a very strong absolute morality in mind. I'm not saying that. I'm saying that essentially, all right, it is a secular business, and it's been informed with that, and it's blossomed as that as such in America in Western culture. So, you know, there's no altruism there. I'm going to break this video up. We'll come back for a third session.